Well, look, as a kid, I started work. My first summer job at Citibank in the investment research bar was 50 years ago this summer. Wow. And the bank was what was called the Nifty 50 investor. They bought the stocks of the 50 best and fastest growing companies in America under the premise that A, nothing could go wrong with these companies because they were bulletproof, and B, if you paid a price that was a little high for the intrinsic value at that time, it would grow so fast that it would grow into its price and make you money. So the official dictum was that there's no such thing as a price too high. And if you bought those stocks the day I arrived at the bank and held them for 5 or 6 years, you lost almost all your money in the best companies in America. So then in 78, I switched to investing in high-yield bonds, so-called junk bonds. Now I'm investing in the worst companies in America, and I'm making money steadily and safely. Well, so if you can lose a lot of money in the best companies and make money in the worst companies, then it can't be true that the secret to good investing is buying high-quality assets. And that's when I concluded that it's not what you buy, it's what you pay.
Well, didn't you say there's another great quote of yours, like I said, you have so many, where you said you looked into the dictionary when you were investing in junk bonds, and you looked to see what is the definition of the B rating or whatever the credit rating was, and it was does not have the attributes of a desirable investment or something like that.
Yeah, that was actually Moody's manual where they publish all their bond ratings. Of course, everything was published on paper in those days, and it was a big book that sat on a shelf because it had information on the bonds of every company outstanding. And they said, fails to possess the characteristics of a desirable investment. Now, if when we get through with this interview, we go down to the street and I show you my car, and you need a car, and I have a car I want to sell, and I say, Demetri, would you like to buy my car? Hopefully, there's a question you would ask me before you say yes, and that is, what's the price? You can't...
Or let me see the car.
Well, but the point is, you can't intelligently make a decision about whether something's a good buy until you know the price. Moody's was saying that if a bond has questionable creditworthiness, it's not a good buy regardless of the price, and that can't be right if you think about it. That is the kind of thinking that gave way to the junk bond era, which started 40 years ago in 1978 and has transformed the investment and financial world.